The World Bank states in a recently released book that they have low expectations for future economic growth. Specifically, they suggest that potential growth, meaning the economic growth will fluctuate around as the business cycle of the economy goes up and down, has likely stagnated and will be noticeably lower in the future. The claim is that almost all forces that drove growth and prosperity in the latter part of the 20th century have weakened. They argue that the number of investments is declining, productivity is decreasing, the workforce is aging and growing more slowly, global trade growth is much weaker, and finally, climate change is placing constraints on growth, both through fewer available resources and more expected negative shocks from natural disasters and changing climates. To make a 180 pages long story short, it looks grim. Forces that have previously been a wind in our back that has allowed us to increase our prosperity have now turned. We will likely have to persevere with a strong headwind at least until the end of this decade, according to the World Bank. Let's assume that the World Bank is right. Growth will be lower for a considerable time ahead. Let's further assume that central banks are also correct in their claims that interest rates will be kept higher and for longer. Given this, we could have a situation where the interest rate is higher than economic growth, something we have not seen on a global scale for extended periods in the past. What does this mean for how our lives will unfold during the rest of the 2020s? I see three problematic consequences of the economic growth being lower than the interest rate. Let's first analyze what a higher interest rate than growth means for inequality. The French economist Thomas Piketty wrote the influential book Capital in the 21st Century, explaining that the increased economic inequality of recent decades can be explained by the interest rate being higher than economic growth. Interest is the return that capital owners receive for renting out their capital. Meanwhile, workers' wages are strongly linked to economic growth. When workers become more productive, growth increases, and simultaneously the utility of labor increases, leading to wage growth. In a future where we will likely see an interest rate higher than economic growth, there are good reasons to believe that economic inequality will continue to grow. It is positive that a significantly larger part of the population, regardless of whether their primary income is salary or interest income, is now involved in the stock market than in the 20th century. Previously, only a small percentage of the population owned capital, causing the wealth of these few individuals to skyrocket, far from others' fortunes. Nowadays, the stock market is not just for the elite. Most people have sufficient knowledge to save a portion of their income in funds or stocks, allowing them to join the same journey as the major capital owners. Participation in the stock market is even greater when we consider people's pension savings, which increasingly consist of acquiring capital instead of receiving a check from the state every month. However, the snowball effect still remains. Those who have more will still earn the most, meaning that a more economically unequal world can be expected for some time to come. The snowball effect also leads us to the next perspective from which we can analyze a higher interest rate than growth, which is government debt. Government debt, in absolute terms, is rather uninteresting. What matters is how large the government debt is in relation to the GDP, similar to how the size of a private loan depends on the individual's income. Therefore, we often look at the equation of government debt divided by GDP. As long as the ratio of government debt to GDP is relatively low, there is no cause for concern because the state can reasonably easily pay off the debt. assuming that the government does not take on new loans or pay off its previous loans. If the growth of GDP is greater than the interest on the government debt, the ratio will decrease. This has often been the case during the 20th century, as economic growth has been good while the state has been able to borrow at a low interest rate. Now, assuming the situation is reversed, that the interest is greater than economic growth, the ratio will instead increase, regardless of whether the government takes on new loans or not. Let a few years pass, and the ratio will increase rapidly due to the snowball effect I referred to earlier. Historically, such a catastrophic situation has only occurred in individual countries, forcing significant economic support packages from other countries. Take for example Greece during the Euro crisis, which still hasn't managed to absolve itself from the assistance the country received from the EU. Now, imagine that the same scenario could occur on a global scale, not just in individual and smaller countries like Greece, and happen in world-leading countries like the USA, Germany, and China. Yeah, it's not a pretty sight. A third perspective to analyze a higher interest rate than economic growth from is based on consumption decisions and unemployment. It may feel distant now, but an interest rate higher than growth can lead to too low inflation for the economy's well-being. When the interest rate is high, there is a greater incentive for households to save their money. At the same time, a high interest rate makes borrowing more expensive, which can decrease household consumption while the economy slows down with fewer investments. When consumption decreases, so does inflation. In the worst case scenario, inflation decreases all the way down to deflation, meaning that prices fall over time. This is a harmful trend that is difficult to reverse for the economy because households choose to postpone consumption until the next year as prices decline. When consumption decreases, companies must lay off workers and lower prices further, reinforcing the vicious circle where deflation and unemployment lead to more deflation and unemployment. You might ask how difficult it is to reverse the trend and how devastating it is for the economy. Ask Japan, which fought against deflation and stagnation between 1991 and 2001. They refer to the period as the lost decade and label the individuals who were at the beginning of their careers during that time as the lost generation. Well then, this was indeed a depressing story, but this was also my intention to make a point. Yuval Noah Harari, an Israeli author and historian, was the one who explained it most clearly to me. Forecasts and predictions about the future are not valuable because they necessarily prove to be right. Instead, they are valuable because they tell us where we are heading if we continue on the current path. Forecasts give us an opportunity to consider whether we are doing the right thing or if we should do something different to arrive at a different, better point than the one we are currently heading toward. Rest assured, smarter people than me have put together the combination of lower growth and higher interest and calculated what it will lead to. Now that the inflation crisis seems to have blown over in most parts of the world, much of economists' energy will be focused on preventing my forecast for the future from becoming true. Either by preventing growth from actually falling below the interest rate level, for example, by encouraging trade and investment, incentivizing workers to work longer before retirement, and encouraging companies to expedite a green transition and contemplate how artificial intelligence can be used to increase productivity. Or alternatively, by mitigating the economic effects of growth continuously being lower than the interest rate in the future. For instance, through efficiencies in governmental budgets and repayment plans, greater economic redistribution, and opportunities for wage earners to get a share in capital income, and ensuring that consumption is maintained at a sufficiently high level to avoid a downward spiral. The Roman philosopher Seneca is said to have stated, "There are more things to alarm us than harm us, and we suffer more in apprehension than in reality." His point was that we should not subject ourselves to unnecessary suffering by constantly worrying about the future, given that the future is beyond our control. In this case, the future is something we can influence, and our concern is the first step in doing something about it, to avoid suffering in reality.